Here's a summary of JPMorgan Chase's JPM Q1 2026 earnings call transcript, focusing on key financial metrics, management insights, and future outlook, suitable for reading aloud. Introduction. Good morning, ladies and gentlemen. Welcome to JPMorgan Chase's first quarter 2026 earnings call. We'll now turn to the presentation where Jeremy Barnum, Chief Financial Officer, and Jamie Dimon, Chairman and CEO, will provide an overview. Financial highlights. Jeremy Barnum began by outlining the firm's strong performance for the quarter. JPMorgan Chase reported a net income of $16.5 billion, translating to EPS of $5.94, with an impressive return on tangible common equity, ROTCE, of 23%. Total revenue reached $50.5 billion, a 10% increase year-on-year. This growth was primarily fueled by robust performance in markets revenue, higher asset management and investment banking fees, and an increase in net interest income, NII, driven by balance sheet growth. This was partially offset by the impact of lower interest rates. On the expense front, total expenses were $26.9 billion, a 14% increase year-on-year. This rise was attributed to higher compensation costs, including revenue-related bonuses and growth in front-office personnel, as well as increased brokerage and distribution fees. The prior year's figures also benefited from the absence of an FDIC special accrual release. Credit costs for the quarter amounted to $2.5 billion, with net charge-offs at $2.3 billion and a net reserve build of $191 million. The firm ended the quarter with a standardized CET1 ratio of 14.3%, a decrease of 30 basis points from the prior quarter, as net income was more than offset by capital distributions and higher risk-weighted assets, RWAs. Standardized RWAs increased by $60 billion, predominantly in the markets business, due to higher client activity, seasonal effects, and elevated energy prices impacting market and credit risk. Basel III Endgame and GSIB proposals. A significant portion of the call focused on the recently released Basel III Endgame and GSIB reproposals. Jeremy Barnum expressed concerns, particularly with the GSIB proposals, noting that their preliminary estimates show a potentially larger impact on JPMorgan Chase compared to aggregate estimates for other large banks. Under the proposed rules, their CET1 capital would need to increase by approximately 4%, contrasting with an estimated 5% reduction for large banks combined. JPMorgan Chase advocates for regulators to calculate capital requirements correctly without bias to specific firms or the industry, suggesting explicit conservatism rather than embedding it in methodology. The GSIB surcharge, under the reproposed rule, appears considerably high in historical context. While concepts like averaging smaller buckets and reweighting short-term wholesale funding were welcomed, the proposed changes, particularly in short-term wholesale funding methodology, could add about $22 billion in GSIB-specific capital, with JPMorgan Chase accounting for roughly $13 billion. This could result in a total increase of about $20 billion in GSIB capital based on their current balance sheet, leading to a higher cost of credit for U.S. households and businesses from JPMorgan Chase compared to non-GSIB banks. Management stressed the need for these points to be addressed for a coherent framework. Business segment performance. Consumer and Community Banking, CCB, reported net income of $5 billion and revenue of $19.6 billion, up 7% year-on-year. This was driven by higher card NII from increased revolving balances and higher operating lease income in auto. Consumer spending growth remains above last year's pace, and average deposits were up 2%. Client investment assets saw an 18% increase. Home lending originations rose 46% year-on-year. Corporate and Investment Bank, CIB generated net income of $9 billion on revenue of $23.4 billion, a 19% increase year-on-year. Investment banking fees were up 28%, led by strong M&A and equity underwriting, partially offset by lower debt underwriting. Markets revenues saw a 21% increase in fixed income and a 17% increase in equities due to higher client activity. Asset and Wealth Management, AWM, achieved net income of $1.8 billion with a pre-tax margin of 35%. Revenue was $6.4 billion, up 11% year-on-year, driven by growth in management fees from net inflows and higher market levels, along with increased brokerage activity. Assets under management, AUM, grew 16% year-on-year to $4.8 trillion, and client assets rose 18% to $7.1 trillion. Corporate reported net income of $699 million on revenue of $1.2 billion. Outlook and forecasts. For the full year 2026, JPMorgan Chase continues to expect NII ex markets to be around $95 billion. Total NII is now projected to be approximately $103 billion, with markets NII decreasing to about $8 billion due to rates, largely offset by an increase in non-interest revenue, NR. The adjusted expense outlook remains around $105 billion, and the card net charge-off rate is expected to be approximately 3.4%. Regarding loan and deposit growth, the firm reiterated its expectation for card loan growth of 6% or slightly more. Other areas are expected to see more modest growth, with headwinds in home lending due to portfolio roll-offs. Wholesale loan growth is expected to be opportunistic, driven by areas like data center lending. Consumer deposit growth is anticipated to be in the low to mid-single digits, with more confidence expected after the tax season. Wholesale deposit growth is expected to be significantly less robust than the exceptionally strong prior year. Key statements from management: Jamie Dimon, Chairman and CEO, on the AI Cash tool. We're trying to make it easier for clients to manage their money. It may squeeze some margin somewhere and create more competition, but that's life. We're looking at the world from the customer's point of view. He emphasized it's in early stages and competition for deposits is fierce. On private credit, he maintained his view that private credit is not systemic and that losses, while potentially worse than anticipated in a credit cycle, would not cause systemic issues for banks. He highlighted the scale of various credit markets to put private credit into perspective, and noted that most issues would require significant private credit losses before materially impacting banks. His primary worry is the broader system. On consumer resilience, there really is not anything new or interesting to say this quarter. We've looked at it through every angle. It all looks consistent with prior trends and fundamentally healthy. He cautioned that a weakening labor market, potentially driven by geopolitical events and higher energy prices, would be the main driver of consumer stress. On cyber risk, it is our largest risk. While AI has complicated the situation, we invest significantly and are well protected. It's a complex issue requiring continuous effort. He stressed the importance of basic cyber hygiene. On AI opportunity, it creates opportunities because you can use your relations with the clients, the data you have to make the client happier. We do a lot to reduce risk and fraud and scam by using AI. He cautioned against expecting AI to solely improve efficiency ratios, as benefits will likely be passed to the marketplace. On trading business, our team does an outstanding job. We engage in transactions amounting to nearly $4 trillion daily. We provide excellent products, service, and execution to our clients. He noted that while volatility can sometimes lead to losses, the overall business serves significant global investors and is a solid operation. He also highlighted that increased capital deployment is a driver of recent strong performance. on higher for longer rates. When we assess the current environment, it's essential to consider the potential outcomes of a recession. If stagflation occurs, along with prolonged higher interest rates and widening credit spreads, it will create significant stress for companies with leverage. He believes a credit cycle might be more severe than anticipated but not systemic. On investment banking pipeline, I would describe it as resilient, maybe surprisingly resilient, given everything that's going on. He noted that timelines in the Middle East are short, but any derailment could impact sentiment and deal decision-making. On GSIB surcharge impact, that's a significant reason we discussed the issue regarding the surcharge today. It mainly affects the market's business. Therefore, we believe it's crucial for regulators to carefully consider their actual objectives. He also mentioned they would explore ways to mitigate the charge. Jeremy Barnum, Chief Financial Officer on GSIB proposals, highlighted concerns with the GSIB proposals, noting their estimated impact on JPMorgan Chase is worse than aggregate estimates for other large banks. He stressed that the surcharge could increase the cost of credit domestically. On NII outlook, explained that the NIX market's outlook remained unchanged despite higher rates because the impact of backdated rate cuts meant the full-year average increase was only about 20 basis points. On expense management, advised against annualizing the first quarter's expense run rate due to seasonality, especially in markets revenue. He stated that the $105 billion expense target is an outcome of business results, and if volumes remain strong, they would spend more. On stablecoins and digital assets, there's significant legislative and regulatory activity happening. The wholesale payments sector is already highly efficient. On the consumer side, the biggest question is the use case. We advocate for clarity from legislation. He emphasized the need for consistent regulation. On private credit exposure, sized their core private credit exposure at approximately $50 billion, defined as the portion of NBFI involving leveraged loan investors, characterized by robust underwriting and protections. On consumer deposit growth, it's a little bit too early to sort of say, yay, we're back with super robust consumer deposit growth. Our consumer deposit growth expectations being low to mid-single digits. And I think that is still the belief. He noted that net new checking accounts are strong, but yield-seeking flows will influence balances per account. Significant risk factors, regulatory uncertainty, the Basel III Endgame and GSIB reproposals represent a significant near-term risk, with potential impacts on capital requirements and business economics, particularly for the market's business. Geopolitical instability. Developments in the Middle East could impact deal execution, commodity prices, and global economic outlook, potentially affecting consumer resilience and overall market sentiment. Cyber risk. While the firm is well protected and invests heavily, the increasing sophistication of AI-enabled cyber threats remains a significant and evolving risk. Credit cycle. Although not seen as systemic, a credit cycle could be more severe than anticipated, especially for leveraged companies facing higher for longer rates and potential stagflation. Interest rate environment. While the firm is asset sensitive, lower than expected rate cuts could impact NII and the broader economic outlook. Lowlights, increased expenses. The 14% year-on-year increase in expenses, driven by compensation and growth in personnel, is a notable point, though largely attributed to strong revenue performance. GSIB proposal impact. The potential negative impact of the GSIB reproposals on capital requirements and competitiveness is a significant concern. Consumer deposit growth nuance. While stable, the pace of consumer deposit growth remains moderate, with expectations contingent on factors like tax season and yield-seeking behaviors. Overall sentiment. The overarching sentiment from the call was one of resilience and strategic positioning. JPMorgan Chase demonstrated strong financial performance in Q1 2026, driven by robust activity across its key businesses. Management expressed confidence in the underlying strength of the consumer and the firm's ability to navigate economic uncertainties. However, significant attention was directed towards the evolving regulatory landscape, particularly the Basel III Endgame and GSIB proposals, which are viewed as potential challenges requiring careful management and advocacy. The firm remains committed to serving its clients and leveraging new technologies like AI, while diligently managing risks.